Hello and welcome. In this lecture video, we'll be doing some examples of analyzing transactions and double entry accounting in the form of journal entries. So we'll do some journal entries. And then we'll also do some T accounts to simulate posting those journal entries to the general ledger. Okay. So I'm going to go on to the next page now, on page 29 of your course pack. And we see the first one is owner invested $30,000 in the Fast Forward business. Okay. So what I have right over here I have analysis, I have double entry, and then I have posting. And so when I talk about analysis, what I'm talking about is showing the accounting equation with the debits and credits overlaid on the accounting equation. And then what parts of the accounting equation are going up, what parts are going down. And then the double entry, I mean doing the journal entry. Posting, what I mean is simulating posting from the journal entries to the general ledger. So with the posting here, we're going to do those T accounts. Okay. So let's look at the first one. Again, we invest money in our company. So we come over here and we say, basically, we have to figure out what's happening. What accounts are being affected? $30,000. That's cash. So cash is going up. He's investing cash in his business. Okay. What else is going up? Well, this is owner investment. So it says that means owner's capital. So whenever we have, this is a transaction, this is an event, and we need to record this with journal entries and then post it to the general ledger. That's what we eventually want to do. So we have to figure out, first of all, what accounts are being affected. So we have to read this word problem and figure out, parse it and say, what accounts are being affected? Well, I can see this is $30,000. That's cash. Owner investment, the key word owner invested, that means owner's capital. So now I can do this in terms of my accounting equation. Remember, assets. Assets equals liabilities plus equity. Right? Cash. So remember, I got my debit over here, my credit on top of my liabilities and equity, then my debit. What is going up? Cash. So assets are going up in the form of cash by $30,000, which means the left side of this accounting equation is going up by $30,000. That means the right side, liabilities and equity, also has to go up because this has to stay in balance. So what is going on with the right side? Liabilities are not being affected. This is owner investment, which is owner capital. And we know that owner's capital is going up. So how do I represent that? As owner's capital goes up, equity goes up. So owner's capital goes up by $30,000, which is my equity. All right. So now what I can do is I can translate that into a journal entry. So that's where I have to do my debits and credits. Now, when I write out my journal entry, there is a convention. Okay. I write out my debits first and I list them down, all my debits, and then I indent and list my credits. So if I look over here, I say cash is an asset, cash is going up. How do I recognize that an asset increases with a debit? So I'm going to write down, I'm going to give the date, 12/1, just like that. And I'm going to write down the account being affected, which is cash. And then I'm going to write the dollar amount of $30,000. So I've got cash, $30,000. Cash is it's debit to cash. Why a debit? Because I'm investing cash in the business's cash is going up. Cash is an asset. How do I recognize that an asset is increasing with a debit? What else is going up? Owner's capital, because of owner investment. So I'll come over here, and we know this is for Chaz Taylor. That's our example, working example, Chaz Taylor. Okay. So I'll say C. Taylor, short for Chaz, C. Taylor, capital, comma, capital, $30,000. That is my journal entry. So I write the date, and I debit cash, and I write cash, $30,000. I don't have to write debit. I can just show my debit by starting, and then I indent and then show my credit to C. Taylor Capital. Why is it a credit to capital? Because the way I increase owner's capital is with a credit. Why do I increase owner's capital with a credit? Because as owner's capital goes up, equity goes up, and equity is on the right side of the accounting equation. How do I increase equity with a credit? That's why. So now what I can do is simulate this in terms of my T account. So I've got my cash, do my cash, big T account, C. Taylor Capital, big T account. And what I have over here is I can say, this is 30,000 debit to cash. The left side of my T account is the debit side. So I put it on the left side right there. The right side of my T account is the credit, and I don't have a credit to cash. I only have a debit, right? And that's to C. Taylor Capital. So I put that on the right side of the C. Taylor Capital T account to represent the credit. Okay. Now notice that my total debits, which is $30,000, equals my total credits, which is also $30,000. And as I was saying earlier, your total debits have to equal your total credits. Otherwise, the accounting equation will not stay in balance. Okay. So let's look at this next one. Example 2, fast forward purchases supplies by paying $2,500 cash. I write out my accounting equation. Right? What things are being affected? Well, purchases supplies. Where do I put supplies in terms of the accounting equation? That is an asset. By paying $2,500 cash. That's my other keyword, cash. Where do I put cash in terms of the accounting equation? That's also an asset. Do I see anything going on with liabilities or equity? No. Supplies is an asset, cash is an asset. The only thing that's being affected are assets. So there's nothing going on with the right side of the accounting equation at all. Now, what's going on is that one asset, which is supplies, I'm purchasing supplies, so that means the value of the supplies that I have is going up. But I have to pay cash, which means I have $2,500 less cash in my bank account. So cash is going down. If we remember, the way to increase an asset is with the debit. The way to decrease an asset is with the credit. So cash, I'll write that up here, or I'll say supplies, is going up. Cash is going down. On the asset side, there's nothing going on the right side of the accounting equation at all. Okay. Now, we can do this in terms of debits and credits. Supplies, which is an asset, is increasing. How do I recognize that an asset is increasing? Is with a debit. So I will debit supplies for $2,500. Cash, which is another asset, is going down. How do I recognize that cash is going down? It's with a credit. So then I will credit my cash right over here. And again, the way I write out my journal entry is I list my debits and I indent and then list my credits. Debit to supplies, $2,500. Credit to cash, $2,500. Let's look at our T accounts. So we have our cash. And then what we have over here is our supplies. So with our cash, remember from the first part, from example 1, we invested $30,000 cash. So that's on the debit side of the T account for cash. And then I have $2,500 right over here, which I'm going to put on the right side of the T account for cash because it's a credit to cash. So the way I would calculate the balance in cash after I paid for the supplies is I would take the $30,000 debit to cash minus the $2,500 credit to cash, and then that would give me my balance in cash. With my supplies, I write that. We can see it's a debit to supplies because supplies are going up, and supplies are an asset. The way I increase an asset is with the debit. So I debit supplies for $2,500. Okay, and that's on the debit side of the supplies T account, which is on the left side. Remember, with our T accounts, the left side is the debit, the right side is the credit, regardless of whether it's cash, supplies, accounts payable, whatever. Left side is always debit, right side is always credit. Now, whether that debit or credit means increase or decrease depends upon where you are in terms of the accounting equation. Also, debits, credits do not mean good, bad. They don't mean good, bad. They mean left, right. And they mean increase asset, debit, decrease asset, credit, increase liability, credit, decrease liability, debit, increase equity, credit, decrease equity, debit. That's what it means. It doesn't mean good or bad. Okay? And it doesn't always mean plus or minus. Depends upon where you are in terms of the accounting equation. With reference to T accounts, debit is always on the left. Credit is always on the right. Okay? So here's what I want you to do. I want you to pause the lecture video and do these problems, example 3, 4, and 5 on pages 30 and 31, and then we'll come back and check it. Okay? Thanks. Okay, hello and welcome back. So let's take a look at example 3 and see how you did. Fast forward purchases equipment by paying $26,000 cash. Equipment, which is one asset, is going up. Cash, another asset, is going down. How do I know that? Look at what it says. Purchases equipment, keyword asset, by paying cash, another asset. Whenever I pay cash, that means cash is going down. Cash is going down. I purchase equipment. Equipment is going up. How do I recognize that an asset is going up? With a debit. So debit equipment. How do I recognize that an asset is going down, which is cash? With a credit. Debit equipment, credit to cash. And then I can show that in terms of my T accounts. I have my equipment T account. The left side is the debit side. So I got $26,000 there. And then with my cash, I still have my $30,000 on my debit side from example 1. Credit to cash for $2,500, which was the supplies that we bought in example 2. And then the $26,000 of equipment that I bought right over here in example 3 on the credit side. The way I would calculate the balance in cash, how much cash I have in my bank account, is I would take my $30,000 minus my $2,500 minus my $26,000, and then that would give me my balance in cash right there. Okay? Let's look at example 4. Fast forward purchases $7,100 worth of supplies on credit. So when this says supplies, we know right away this is an asset. When this says on credit, that means we're not paying for it now. We're going to pay for it later. So we put it on the credit card. Think of it that way. It's fine to think of it that way. So we put it on the credit card. Now, why do we have to put it on the credit card? Well, we don't have enough cash, right? We don't have enough cash. We don't have $7,100 cash left over. It's $30,000 minus the $2,500 minus the $26,000. That's a lot less than $7,100. We don't have that much cash. So we have to put it on the credit card. So whenever you see this, it says on credit, that means accounts payable. That means accounts payable. And accounts payable is a liability. So when we look at this effect on the accounting equation, assets, which are supplies, supplies are an asset. Assets are going up. Liabilities are going up because this is an accounts payable. It says on credit. Accounts payable are going up, so liabilities are going up. Equity is not affected. So our journal entry becomes a debit to supplies, credit, indent, write out the credit, accounts payable, and I have AP, $7,100 right there. And I have my supplies T account right over here. Supplies, and remember I bought supplies at $2,500, bought another $7,100 worth of supplies right there. And then I just have my accounts payable, and that's on my credit side, $7,100. Remember, with the T account, debits are always on the right, on the left. Credits are always on the right. Debits on the left, credits on the right. Let's look at our final example right over here. Fast forward provides consulting services and immediately collects $4,200 cash. What are some of the keywords? Provides services. This means revenue. And collects cash. That's my other keyword. That's what's going on. Underlying these keywords helps me to figure out what accounts are being affected. So what accounts are being affected? Cash, which is an asset, and then equity, because revenues are increasing. Remember, revenues increase equity. So my journal entry becomes debit to cash, and then if you just wrote revenues, that's fine for now, but it does say consulting services, so you could say consulting services revenue or consulting revenue. And then we have our T accounts for cash and then consulting revenue. Okay. Thank you so much.